Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thanks everybody for joining us. Today is our episode number 30th, and with Yoshi, and he will introduce himself in a minute. So if you're new here, our focus is how to get started in syndication. That's where we call ourselves 0 to 1, how to get to that first syndication, or if you've already been syndicating, how to get better, how to do your next one better.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
Again, thanks everybody for joining. My name is Marcelo Cazini. I'm here in Houston, Texas. My background is in software development and application management consulting, and I'm a local CCIM member here in Houston with all this required designation trainings. In real estate, I'm a multifamily investor. I also own and operate my own commercial real estate, and I've done fix and flips on the single family space before getting into multifamily.
Hi everybody, this is Claudia Rubio. We're based out of Houston, but I was born in Colombia, South America. I have an architecture degree and I have 26 years of experience doing asset management, mostly managing my own assets. And then when we met with Martin, managing our own assets in Colombia, and now doing multifamily syndication here in Houston.
My name is Martin Rubio. I'm an IT security consultant for over 25 years. We have been related to asset management and business management for a while. Recently, we started doing syndication 2.5 years ago, and we have done a couple deals here in Houston through our syndication business.
All right, thanks, Martin. Yoshi, would like to introduce yourself?
Yes, my name is Yoshi, and I am based in Dallas, Texas. I actually grew up in Japan and moved to California when I was like 20 years old, and I was there in California for 15 years. And I really wanted to get into the commercial real estate investments. That's why I moved to Texas. That was 9 years ago, back in 2012. So I think it was a great time, when I moved to Texas. It was hot already, but it's not as hot as today, right? And after moving there, I started with the fourplex, start small, right? And I quickly realized that it's hard to scale. So I started to do the syndication back in 2014, 2015. So I've been doing this for like 5, 6, 7 years now, more than 1,000 units as a GP. And also I am the broker. Even though I don't practice anymore too much, only referral based only. I don't market to anybody, just the friends and just a referral base. But I've done maybe close to 100 million transaction as a broker as well. So total, the commercial real estate I've been involved is more than 100 million so far. Acquisition over 115. I think it's a little bit more now because I closed the deal last week in Houston. It's 228 units. So that's $24 million acquisition. So it's a little bit more than this, but yeah, so this is me. I'm not just, I'm just a regular guy, come from Japan and start doing these things.
All right, welcome, Yoshi. I also want to ask just everybody what's their real estate experience, so we know our audience. So if you can just take a minute to answer the question there. If you are brand new to real estate, if you are a single family landlord, if you're already syndicated, or if you're just if you've done passive investment. So we're just gonna give everybody a quick minute here so we know who's here today. And that gives
I got a poll too. Should I answer this poll?
Yeah.
Okay.
Yeah, and in the meantime, we're gonna have a small chance for anyone new to introduce themselves if they feel like it. So prepare your elevator speech.
Yep.
Hey,
All
Yoshi,
right.
while we're waiting, I'm curious, like, what's the current travel situation between the US and Japan? Is there a lot of restrictions, or can you go if you have like a negative test or?
Yeah, so Japan actually closed. So only guy with the Japanese passport can get into Japan right now. And even with the Japanese passport, you have to have a test 3 times before you leave, at the airport, and on the way back.
Wow.
Yeah, it's just crazy. So, and then you have to self-quarantine for 14 days.
Oh God.
So it's pretty strict. And if during the 14 days, I haven't been there, but you know, my friend's been there. The government call you and do the Zoom call every day just to check
What?
in here. It's just
Make sure you're
crazy.
quarantining. Yeah.
Yeah, just crazy stuff, you know.
Wow.
Very strict.
Oh.
Yeah.
Yeah, I have a coworker who is from Japan, and his wife went to visit her family or something in March last year, and she was trapped there. And I think my friend lost her wife for like 6 months or something like that until she was able to come back.
Mm.
Wow, it's crazy.
Yeah, they're pretty strict.
So the results of our poll are in. So we have 2 people who are brand new to real estate. So again, welcome. We have 7 people who are single family landlords. Most of you are already passive investing in apartments. And then we have 4 people who already syndicated before.
Yeah, our first question is always, it looks simple, but every single guest has responded differently. What is it about multifamily that attracts you the most, Joshi? Why multifamily?
Yeah, so in general, I wanted to get into commercial, right? Because of the scale, merit. You know, it's bigger deals, and you can expect bigger returns, right? So that's like a general thing, and out of those asset classes, just like, you know, 2020, you know, in the pandemic, multifamily kind of proved that it's a recession-proof type of asset class out of other asset classes in the commercial. So industrial and commercial, I mean, the industrial and multifamily were doing fantastic during 2020, and they're like very hot right now, right? And you know, I was actually considering getting to hospitalities, retails and stuff like that. But the retails and hospitalities, you know, as you probably know, that they have their own challenges done in 2020, and some of the retail come back a little bit, but the hospitality seems to be still, you know, have a lot of challenges, and they're forecasted that they're not going to come back till like 2022. But you know, because of those, you know, the stability of that multifamily is very, you know, attractive to me, and also the number of the units that I can own, right? So if I have multifamily, 100 units multifamily, I have 1 vacant units, it's 99% occupancy, right? But if you have the retail strip mall, same price, same purchase price, you might have 5 tenants or 10 tenants, right? Whatever. So say you have, you know, 5 tenants and you lose 1 tenant, that's, you know, you're like 80% occupancy, right? You drop 20%. So you know, it's more volatile, you know, different asset class, commercial real estate. So that's probably the part of the reason, you know, stability.
Right. Awesome. Thank you. Yeah.
So when you started looking into multifamily, it's a different beast that different beast compared to anything else, right? To single family or anything like that. So the first step usually is to get educated, and everyone does it consciously or unconsciously. Some people are just doing like today with meetups and learning about it. How do you go about getting educated, learning the basics to go into commercial and specifically into multifamily? Did you read books? Did you get in touch with people that knew the business? Did you join a program? What was your approach?
Yeah, I've done all, actually, you know. Listen to podcasts. Podcast is a great source for multifamily. There's tons of hosts talking about multifamilies. So that's a free kind of resource for you. And of course, I read a bunch of books about the commercial real estate or multifamily. And then finally, I found a mentor. It's a paid program, right? So I joined that group and I learned from the mentor, right? So I think pre-educated yourself with the podcasts and books. That's a great way to start if you don't want to spend too much money or just start it right away with the free sources. But I think best way to find a mentor, if you're lucky, you can probably find a mentor down the street in the neighborhood during the multifamily and have like a friendship with him and learn it. Or you can pay to find that you pay to hire the mentor, right? That way it's almost guaranteed that you can have the mentor when you want it. So that's like how I did it. Paid to get the mentorship.
Okay. And then when you had the education and you felt comfortable going out to look for properties, what kind of markets did you focus on and what kind of criteria did you have for that first deal?
Oh, yes. For me, I think I wanted to have the deal close by, at least like a driving distance, because it's a first deal. If you have to fly every time, then that might overwhelm you, right? If it's going to be like a fifth deal for you and you know what to do, then the distance doesn't really matter anymore, because multifamily, you hire third-party management and they're going to be the day-to-day operation guy. So as long as you know how to manage the property management companies, distance really doesn't matter. But for me, for the first deal, I wanted to have within the driving distance, maybe like hour and a half driving distance or so that I can get there anytime I want. And you can just take care of your property, but also your education too, right? Because it's the first rodeo. You want to be there as much as you can, so you can observe like a sponge, like you understand the business in and out, right? If it's flight distance, then you can probably go there maybe once a month, but it goes down to once a quarter. Then you don't get much exposure to the business for the first timers. So first deal, I live in Frisco in DFW area, and the first deal was in Fort Worth. So it was like 50 minutes, about an hour drive distance for me, and it worked out very good. It was 89 units.
Okay. Yeah, that's a pretty common answer. We see people want to have the first one close by to keep an eye, and I think that's because when you started and up to a couple of years ago, everyone wanted to do the first one, being the asset managers, right? Being the ones on top of the property. Nowadays, that's not what everyone wants. They think about giving different type of support to the sponsorship team instead of being the asset managers. But that's a pretty common answer with our guests that have been experienced. They wanted to be the asset managers and they wanted to be right there next to it. Okay.
Yeah.
So how long did it take you to find that first property and get it under contract since you started looking for them?
Yeah, for me, it took a while, right? So I got educations, in few months, like a month or two. And then I got, I was ready. I was ready to find a deal, start looking for the deals. But first couple of deals, I couldn't tell if it's a good deal or bad deal, right? Seems like it's a good deal, but this is the first time and I see like only 2 deals before this, and then it seemed like it's good, so I passed on it. And then, I started submitting offers. It was kind of hard to get awarded, so it took me a while actually. I can't remember, 8 months or 10 months. Start looking for the deals and just submitting offers, and finally I got this offer accepted, and I got the first one.
In your path to the first one, what would you say was the biggest challenge that you had, and how did you overcome it, or how would you overcome it now?
Yeah, so a few things, right? So the experience from the broker's eyes, from the lender's eyes, if you don't have any experience, they're probably not going to talk to you. So I have to find a partner who has experience, so that as a team, we have enough experience to talk to brokers, talk to lenders, get a approval from agency debt, which is Freddie Mac for the first one. So that and equity. So I didn't, I wasn't sure if I can raise this much money. It wasn't a huge raise, if I think right now, but back then it was a huge money, right? It was like 1.5 million raise or something like that. And it was huge money for me, The last deal I did, like just closed last week, was 9.5 million raise. So it's almost 10x, but back then it was a big deal, big money. So I wanted to secure the equity as much as I can before I actually go into the contract. And I was able to secure probably 60-70% of the equity before getting to the deal. So that made me so easy going in and sign a PSA and do the deal.
That's awesome. We do have a question from Marcus. Marcus, do you want to go ahead and ask your question?
Sure, thank you. So I was wondering, when you decided you wanted to start, doing the whole larger 100+ unit apartment syndications, did you, dip your toe in as an LP at all before doing your own deal? And if not, have you since then done any LPs and can talk about those experiences?
Yeah, that's very interesting because usually it's just a typical way, you started as an LP, so you can kind of learn the business and you can kind of be on the passenger seat, kind of watching how it goes and stuff. So I think I recommend doing that, but I never invest as a LP. Actually, the first deal I have done was the GP side, and I was able to, put together a team with the guy with experience for the Fannie Mae's, and also equity, right? So I actually never done LP invest as a LP, but I recommend it, for sure. I think it's a great way to start.
Thank you.
Yeah, I think I'm the one of the few weird guy that never invested in LP and jump onto the GP. Yeah. So
have you since invested in LP, or you still haven't done LP investment?
I had several occasions. I almost did, but the timing was off, whatever the reason may be. So the answer is no. I never invested as an LP.
Got it. So on the first deal that you syndicated, can you tell us about more of the specifics of that deal and what about that deal that felt right for you to be your first deal? So like how many sponsors you had, what location, number of units?
Yeah. So, it's the first one. So I've been looking and, I was like super conservative on the underwrites, and if like 1% off, I was like freaking out. Hey, we need to get to this number. But this property, this deal actually sent it to my way. It was like half off markets because broker was preparing to put on the markets. But one of my friend actually got information about the deal, and he had another deal going on, so he kind of sent it to my way. So I didn't have any competitions, and I underwrote it, and the number works out perfectly. So I start to negotiate and made an offer, and by the time they put on the markets, just to put on the markets to kind of show the seller that, hey, I'm doing the full marketing, right? But by the time they put on the markets, I'm already reviewing the PSA. It's almost a done deal. So I didn't have much competition. So that made me kind of avoid the competitions, and then the deal make it very attractive to me. And then the location was pretty good. It was close to downtown Fort Worth. It's up and coming area. It's a solid C-class neighborhood. So I like the demographics. It's a hardworking, workhorse demographic over there. So a lot of Hispanic too over there. So, and it's just, overall, I really like that deal. And it's, it happens to a lot of you guys. I think I get that all the time. The real estate is more like, it is a number, right? So you have to make sure the number works out, but also it's a gut feeling too. If you, it's like a blind date type of things. You meet this girl, and then you kind of immediately know, like, oh, okay, I like this girl, or oh no, probably this is not my type, right? So real estate is kind of same way to me, right? First impression, like I get the good sense of, oh yeah, I like it. Locations, curb appeals, whatever. The location of the leasing office, and it's a flow to the leasing office, the amenities, all that, right? And then it's the bond, right? Look at the bonds, and I kind of tell, hey, I like this deal or not. So I use a lot of my gut feeling after it passed numbers, number first, but.
And one thing you mentioned that I think is important there, that you got in front of that first deal before it even hit the market. Now, being a brand new investor at that time, and I know right now one of the challenges for a lot of first timers is how to get attention from the broker. Do you have any tips on how, even though it was your first deal, you were able to get first
Right.
dibs on that deal?
Yeah, so one thing you can do is schedule a bunch of tours, just tour the deal. You don't want to be like, kicking tires either, but, if you like the deal, just try to go out there, tour the property, underwrite them, make an offer, just doing the process. And that's the best place to meet the brokers, best place. So you can meet the broker at on site when you tour, and you create the rapport, develop the relationship. That's the best way to develop the relationship.
Got it. Now, one of the things you mentioned about, you said gut feel, but then first is numbers, right? So again, a lot of people here are trying to get better into underwriting. So can you talk about do you have any techniques that you use for, as you start seeing deals, for quickly knowing if you want to move forward, and what is your underwriting process, and maybe what are some of the things that you do to maybe look for opportunities for increasing revenue and decreasing expenses?
Yeah, so I've been looking at a lot of deals, like thousands of the multifamily deals. So when I see the deals, I kind of know the business plan. Hey, this is a huge value add, this type of financing I could do, stuff like that, right? So I kind of have the basic business plan before underwriting the deal. So if it's like say it's already 90% and plus occupancies, and it's stabilized the asset, then that's going to be a value add play for me, like light value add, kind of like hybrid. It's already stabilized, but it has a big meat on the bones. Then it's going to be an agency debt, right? Very simple agency debt. That's going to be Freddie or Fannie, most likely. Then I'm gonna start finding the value add components. It could be just as simple as the rent increase by doing the interior renovations, and it's a norm that you have to kind of look for, like other income sources, right? It could be the patio addition to patio additions, or it could be things like Wi-Fi connections or covered parkings and stuff like that, valet trash services, stuff like that, right? And it depends on the demographic. You kind of have to figure out what kind of service and amenity that type of demographic needs and wants, and then kind of develop that, other income sources. So that's going to be like a income side, right? And then an expense side, only a few things that you can do. I mean, there's an industry standard for all the items for the expenses, right? All the line of the items in expenses. So you kind of see, and if it's a lot higher than standard, something wrong with that. line of item, right? In expense side. So I'm going to dig into that and see if I can reduce it. So find out what's going on and understand what's going on. And if you see the problem, you can solve the problem and then reduce that down to the average expense, right? And another thing you can do is like tax protest for the taxes, negotiate with the insurance. Shop the insurance. Make sure you have a best quote for the insurance. And the payroll, sometimes payroll is way higher than industry standard. Then you go in and why it's high, and if you can feel that you can kind of reduce that payroll, then that's another reduction. And then just negotiating with all these outsourced vendors, and then utility is big ones too. So you might have to shop it, or if you can reduce the usage of the water, that would be the great revenue increase by reducing the expense. So those are things I'll look at it.
Do you have any examples of maybe some creative amenities that you tried in your properties that proved to be really successful, and maybe some examples of amenities that you tried on the business plan, it looked good, but then it proved not to be successful?
I think most of the things that I have done is pretty successful. I like the Wi-Fi connections, so that the property will own the Wi-Fi and they sell the Wi-Fi connection to the tenants. And it's very simple to operate. The leasing agents can just turn it on and off on that unit. So for the tenants, they don't have to deal with the calling to the cable companies, try to open up accounts, pay the deposit, try waiting for cable guy to show up to run the cables and stuff like that. They don't have to do any of that, right? Day of the move in, they only have a Wi-Fi connections there. So it's very convenient, and also I can provide a little bit cheaper price, right, than compared to the typical cable companies. So it's kind of like a win-win situations, and it's a huge income generation. So
what demographics do you see that working better, and what is the investment for putting Wi-Fi on a property?
I think it's two ways to do it. One way is a cheap way, kind of like a hotel. You have one kind of data, the one cable going to the property, and then they have the password, and then they access to the one connection, right? That's for more like a Class C apartments. And if you have a Class B and B and A, I think it has to be an individual connections to each tenant or each unit, and that's what we do. We provide individual connections to each unit, and the cost of doing that is for 200 units apartments, it costs us about a little bit more than $100,000. So that's the initial investment, but it's going to pay itself in probably less than 2 years, and after that, it's going to be a great revenue. Mm-hmm. So that's that. What else? Valet trash. We implemented valet trash it was a reposition deal in Phoenix. It was a C-class deal, and we are kind of repositioned to Class B deals. Then now we start doing a valet trash, and there's no pushback. People love it. And we make a pretty good extra. And another good one is the wash and dryer equipment lease, because there's no investment required. There's no investment requires, because you can lease the equipment from third party, and then you can sublease to the tenants, and then you make the difference, right? So that could be good ones if you have a connections already.
Mm-hmm. Interesting, Yoshi. Going back to your first deal, can you tell us a little bit more about it? Like, what was the strategy, price, the team? How many investors did you have?
Oh yeah. So first deal, I have 2 more GPs. So 3 of us took down the deal. and two of them are actually out of states people, one in New York and one in Hawaii. So I was like, the boots on the ground, like local guy in DFW. But these guys could provide a lot of equity. So that's why, I partner up with them. And one of the guy in New York, she was passively invested before this deal, but she was on KP. She was a KP on a couple of deals. So that's how I get the kind of KP experience as a team. So that helped me to get the first Fannie Mae finance. Deal size is 89 units. It's hard to believe that was like $4 million back then. It could be, and then we sold it for, I can't remember, 8 million or something like that.
Wow.
That was more than years ago. So it could value more than 1 million right now, right? I'm sorry, it could value more than 10 million as of now, but we bought it for like a little bit less than 4 million back then. The business plan was pretty simple. It's a two-story townhome style units. All the units are two-story townhome style. So it was a very spacious units. So attract a lot of families, stuff like that. But they used one of the unit as a leasing office, right? Upstairs, they use it as like a rental video space or something like that back then. Back in 2015, they still have like a video, gallery, whatever, and tenant can, rent the video for free as a amenity package. We actually converted back upstairs to a studio and added the unit. And also there's a huge space in a storage. So we convert half of the space to a one bedroom. So we actually added 2 units. So that was one of the business plan. And then, just freshen up the leasing office with the brand new furnitures, so that it kind of gives the good marketing tool. I'm a strong believer that the leasing office renovation is one of the best marketing you can have on the property, and the model units. So those two are the very critical. So that's what we did. Like we did the nice leasing office, and then it was a hot market. It was always like high 90s occupancy, 97, 98% occupied. So we kept increasing the price. We kept increasing the rents, but still like it's always 90. It's always above 95. So it was, like I said, it was a very strong demographic area. So it was high demand with the short supply of that type of products in the market.
Awesome.
Yeah.
Awesome. So now, if you look back, what things would you do different?
Buy more. I could have bought more, a lot more. So yeah, that's one of the things. I made a lot of offers, maybe 50 offers, 100 offers. I can't remember. And then I only got one right back then in 2015. I could have picked up I could have overpaid all of these units, all of the deals, and still made a lot of money, right? So I could have purchased everything.
Right.
Yeah.
True.
We do have a question for Marcos. Marcos, you want to go ahead and ask?
Sure. So I was wondering, in the last 5 to 7 years, that window of time when you've been syndicating deals, what incident, has surprised you on the apartments, whether it's a finding during your walkthrough or whatever? What has surprised you? What biggest thing surprised you the most?
For the first deal you're talking about?
Any deal you've done in the last 7 years that you syndicated, the larger units.
Okay. Surprises. Well, there's a lot of small surprises. Like, believe it or not, there's a lot. It's not the major issues or anything like that, but there's surprises every day. But one of the things is probably structure, mechanical things that happens in Phoenix Steel is the plumbing, right? We had the plumbing reports and the sewage seems to be okay, but it's galvanized pipe, right? So start to have a leaks for the supply side and also the within the units, right? Which you can't really check that during the due diligence. You can scope the drain, but you cannot check the supply line, right? And you start to make a holes and leaks and end up with spending almost $100,000 to redo whole supply lines.
Oh, wow.
Yeah, that's one of the things. But luckily, we had enough capex reserve to kind of observe that, so it didn't impact financially too much. But that was one of the big surprises that we have. What else? That was pretty much, yeah. And then some of the I've seen all, I've seen, one of the unit got fired, we have to go through all the insurance claims and stuff like that. I had an incident, there was a suicide on site, and that was a very unfortunate event, but, things like that happened. I've seen all, I guess. There was drug dealers, prostitutions, all the stuff.
I could do a follow-up. On that one you were just talking about with the piping, would you say that even though you can't look at that, would you say that something like that is tied to age of the property?
Yeah.
And could be mitigated if someone was, say, buying, only a certain build year and above? That makes sense. Would you say that?
80s and above, it's much better construction, right? So if it's like 60s and 70s, this deal is a 1971 or something like that, right? So it was a galvanized pipe instead of copper pipe, and a galvanized pipe is going to corrode it and crack it over time, So yeah, newer assets, definitely less issues mechanically, mechanics and
Electrical, right?
Yeah, electricals, the HVAC systems, all that. And you kind of know going in, but there's no perfect deal, right? You have to kind of adjust the risk and knowing the risk and getting to the deal, right? There's no perfect deal, best locations, but it's a 60s vintage, it's a little weak locations, but the asset condition is perfect, or something. There's always something. So you have to look at the overall, risk and reward, and you can have a calculated risk and get into the deal.
But are there any deal killers for you? Things that you will see and you will say, no, I'm not getting into this deal.
I'm pretty optimistic when it comes to the deal hunting. So I don't have much, but I try to stay away from old buildings because of the experience, right? We had to change the boiler and chiller on that deal, and we knew it and we budgeted, and but it's not fun spending like $400,000 just to replace the chiller and the boiler for no value add, right? I mean, it's value add in a way because, the next purchaser will see it as, oh, hey, this is a chiller system property, but it's brand new. So, they don't really care about getting to the chiller system property, right? Mm-hmm. So that's a value that we created, but for the rents and stuff like that, there's no value add components. So, I would want to spend that $400,000 for the unit renovations, adding the fun amenities, stuff like that, right? That's more fun doing that, and also also, you can see the results in a bottom line. So I like the newer deals.
Okay.
But only time I think I get into the old buildings is gonna be like locations. Locations like A+ locations in near uptown or downtown, and you can't replace the location type of deal. Then I might go into the old buildings. But besides that, I'm just stay away from the old buildings.
So 1980s and above is what you're looking for right now.
At 1980s, right now the last deal is 1995. And I want to get into a little bit nicer, like 2000 buildings too.
Great.
Okay.
Yeah.
So going back to that first deal, after you acquired it, how long did it take you and your team to stabilize that deal?
It was stabilized asset, so it was pretty simple. Like I said, we added 2 more units and started doing the interior renovation package, and it was just a pretty simple, because I've done like single family flips and stuff too, and it's like a lot of stuff, right? Like it's single families, you have to very pay attention to the details for the interior renovations. Class C apartments, it was very, very easy compared to that. Just vinyl flooring, 2-tone paint, resurface the countertops, changing the lighting and plumbing fixtures, and call it renovated units, and then maybe change the appliances. Yeah, so just doing that. So it was stabilized asset. It was pretty simple. And then I strongly recommend to get into the stabilized asset if you're a first timer. It saves a lot of headache.
Do you recommend somebody looking into adding new units like you were doing? Did you have any challenges dealing with inspections and code compliance? Was it pretty smooth adding those new units, or is that something a first timer should look into, or should they avoid it?
Yeah, absolutely. Yeah. It's not hard. I mean, hopefully your deal is in Texas, right? And it's not that hard. It's gonna be a huge value add. Think about it. You add 1 more unit, you add like $1,000 a month income. That's a huge value add. And if you spend like say $15,000 to do that, it's gonna pay itself in like 15 months, and in the value you created is huge.
Yeah.
Right.
So when you talk about that, let's say stabilization, which in your case it was already stabilized, let's talk more about the business plan.
Okay.
How long into the business plan were you comfortable enough to go chase the second property?
So chasing the second property, to me right now, like I'm always chasing, regardless. But the first one, I was kind of off market, myself, right? I wasn't looking. So for transfer from old ownership to the new ownership, takes a while, right? So property management team comes in, and then they do that transfer of all these documents, the ownerships, the name of the properties, all that, right? And the business, and the permits and stuff, business permits and stuff. So I would give myself probably, at least a month or so until the new property management team is settled into the property and make sure that all the operation is functioning.
Mm-hmm.
You see that it's keep going and the occupancy is stable. I would probably spend like a month to make sure that everything's good.
Mm-hmm.
Okay. And nowadays, are you focused only on a specific market like DFW or all of Texas, or what are your markets right now?
So it's Dallas, Houston, and Phoenix is 3 markets I'm in. And for the multifamily, I prefer to pick up from those 3 markets because I already have deals over, in the markets. So it's much easier for me, and those are the good markets. So I prefer in those 3 markets. But if there's opportunity, if there's opportunity, and then there's a the operator will operate the deal in, say, Florida, and then partner up with them, why not, right? Those three markets.
Okay, you said you have a deal in El Paso. You're not looking in El Paso anymore?
I was looking a little bit just to kind of understand the market, and those secondary and tertiary markets, you gotta be in the long term, sometimes the investors are not as patient as the GP side. I want to have results quicker than that, because El Paso or like secondary and tertiary markets, you got to look at like 10-year hold, 7 to 10-year hold instead of 3 to 5-year hold to have enough appreciations. It's going to be a longer play, longer hold, and nothing wrong with that, right? If all the investors are like that way and collect cash flow as long as they can, and that's going to be your deal. For me, I want to turn like 3 to 5 years instead of 5 to 7 years.
Mm-hmm.
Okay, and we have a couple questions here in the chat. So the first one is, what have you found to be the best way to find and connect with potential investors?
Networking events like this. So I think it's good to have introduction going, so that people know you and start talking to the people. It's just networking. Just there's no other way. I mean, when I say networking, it could be virtual too, right? Social medias and stuff like that, podcasts. You could host podcasts and stuff like that, and then virtually network. That's another way to do it. But simple ways: attending networking events, either face to face or the virtual, and then try to get to know the people.
Mm-hmm.
Okay, and then the other question is, if you bought a property where all units needed to be updated, what would your approach be as far as scheduling, rent increases, turnover, common area improvements?
Yeah, what I would do is I'm gonna take care of the amenities and exterior first. So it's gonna be the best marketing. Like I said, if deal looks good outside, walking into the leasing office, and leasing office looks like a brand new Class A deal with the nice furnitures, nice decors, you sold, they all sold 50%. And if you have like a nice model, then they are sold. It's a strong marketing. So I'll do that first. And then I'm not going to drop the occupancy less than 90% if I don't have to. So if it's a 100 units deal, then probably 5 units a month. I'm going to turn 5 units a month. And over time, over 18 to 24 months, I have all the units upgraded.
Mm-hmm.
Yeah, that makes sense.
Mm-hmm.
And given what we went through last year and still going this year with COVID, I know, like you mentioned, multifamily is more resilient, but have you adjusted anything on your underwriting as you're looking for properties now, in terms of maybe not being as aggressive year one, or how have the COVID situation changed the way you look into properties now?
Yeah, you probably see a lot of GPs doing the same thing, but I don't do any revenue increase for the first year. I'm still pushing, and probably I have a 5-6% increase in revenue in first year, but I don't underwrite it, right? So it's a 0% increase for the first year. That's one thing. So if something happened like last year, I should be able to get through without any I should be able to still hit the projections, right? But most likely it's recovering, it's coming back. The economy is coming back, seems like. So at least in Texas, it's 100% open now. So I would probably see 5-6% increase. So that's one. What else? The rent increase, I always conservative throughout 5-year hold. probably 2% throughout. What else? The expense, you always have to watch like tax expense, insurance expense. Those are always going up. So you have to have enough. You have to account for it for year 2, 3, and 4, so that make sure that you can observe those increases. Reversion cap depends on the locations and the cities. I usually use 50 to 100 basis point higher than markets. But in Texas markets, I would personally think that it's going to be same or lower next 3 to 5 years, right? So if you have like 50 to 100 basis point higher, then you're in the safe side. What else? Depends on the debt too, if you have like a bridge or some different type of finance, then you're going to make sure that you have enough wiggle room for refi and stuff like that. And I always make sure that, if it's like a 311 type of bridge loan on the deal, then I want to refinance it in 24 months, right? I don't want to wait till like 30 or 36 months comes, just to have the enough wiggle room to make it happen. Stuff like that. Interest rates. It's not the pandemic or anything like that, but the last deal we have done is a floater, meaning it's a floating interest rate. Make sure that you kind of see the predictions, what's going to happen next 3-4 years, and it seems like interest is going to be stay low. Like Fed announced that until 2023 it's going to stay the low. But you never know, right? Make sure you buy the cap, just to mitigate the risk of rate goes up and stuff like that. And for pandemic, COVID-19, yeah, I prefer like class B deals, B plus, or a little bit nicer asset than C class, because it seems like B class did the best out of these A, B, and C classes during the pandemic. So for that reason, I like B even better now than before. Those demographic has the less impact during the pandemics.
Right. Great advice, Yoshi. It's been amazing to have you and all the feedback and all the things we've learned from you.
Time flies.
Yep. Yes, but I would like to ask you if you have any final words of advice for all the people who are aspiring syndicators.
Yeah, so I think making an action is the biggest thing, right? People can think about it, read the books, listen to the podcast, but at some point you gotta pull the trigger, right? So it's like you have to have a good balance. You have to educate yourself. Without education, jump into that, it's gonna be like a suicide, right? But if you have like, for me, if I'm like say 70% ready, I jump in. If it's like less than 70%, I'm not going to do it, but I'm not going to wait till 90%, 100% ready. 70% is a good guideline for me. If you're conservative, wait till 80%, but don't wait till 90% ready to jump into the deal or make an action.
Yeah, that's great advice.
Yep.
So I posted the link to our YouTube channel on the chat. If you haven't joined yet, in case you miss a meeting, you can be notified. And also, if you want to watch some of our past meetings, they're all on YouTube. And with that, I want to mention that we always meet on the first and third Wednesday of every month. So the first Wednesday, we focus on how to get started as a syndicator. And then the third is how to get started as a passive investor. So our next one is going to be April 21st for passive investors, and then we get back again for syndicators on May 5th. And with that, I want to thank Yoshi, and I forgot to mention that you have your own syndication book or real estate book, right, Yoshi?
Right. That's the commercial U.S. commercial real estate investments. written in Japanese, and I just published it last month or 2 months ago in February. And it's all the bookstores nationwide in Japan, and also on the Amazon, both paper and the Kindle. But unfortunately, it's in Japanese, so no English available.
There's another way to meet passive investors. Cool.
Awesome.
Yes,
That's
if you guys want to learn more about real estate or Japanese, feel free to look into Amazon Japan. So thank you so much, Yoshi. I have your email here. So if anybody have any questions for Yoshi, please contact him. And I'm sure he'll have some.
What
good
does
answers
the
for you.
title say, just out of curiosity, on the book?
Yeah, so it said it says start zero, zero to successful commercial real estate investor, and the big font said apartments investment, and my name and stuff like that. Yeah.
Okay, it's fascinating.
Yeah.
Can't read a word of it, but it's fascinating.
Thank you. Yeah.
I still want my signed copy, Yoshi.
Oh yeah. That's
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.